5 customer considerations important to mergers and acquisitions and capital. When pursuing the exit of the business or looking to secure capital, the conversation is ultimately going to shift towards the customers of the company. What does the customer base look like? What's its complexion? How do they behave? Because not only does it allow the acquirer or capital provider to put a value on the business in terms of how much revenue each customer brings in, it also has a meaningful impact on the evaluation of risk or the allocation of risk across that customer base. So the first consideration is concentration. When you look at the largest customer, the largest 5 customers, the largest 10 customers, potentially the largest 20 customers of the business, what do they represent in terms of revenue of the company? One client represents 50% of revenues. That's a meaningful concentration. If you have 100 clients and they are each effectively 1% of revenue, well, then you could see from an acquirer or capital provider's perspective that the risk is much further dispersed or allocated or fragmented amongst the customer base. Second consideration is tenure. How long has someone been with you? We had a recent conversation where someone had indicated, where the question had come up to an acquirer, what level of diligence do you do from a technical basis of the company? And they said, we look at customer tenure. They basically said, if customers have been with you long enough, then what you do works, the product works, right? And so obviously it was a bit facetious. There'd be some level of technical review in any business that you're going to sell for capital, but sometimes the best voting is with people's feet. Do they stay or do they go? Do clients stick around? Does their purchasing increase with the company? And what is the tenure of your longest, again, 5 customers, 10 customers, 20 customers? That often speaks volumes for a business. The third consideration is switching costs or criticality. So criticality is how important is this product, service, or offering to the customer? Can their business function without it? And if the answer is no, then obviously it's a very important thing and something that they will then be much less likely to give up. Switching costs go hand in hand with this in the sense that if someone wanted to replace you with your competitor, how much pain would be involved? Is the business sticky, as you'll hear that expression quite a bit? And so if the switching cost is high, if the criticality is high, then the durability of that customer is equally as high, and the risk of that customer going away is low. Number 4 is pricing power. You'll also hear pricing elasticity. To what extent can pricing be increased and the client still stick around? This doesn't mean that everybody who buys a business or lends capital to business is going to insist that pricing be pushed to the utmost max. But if you increase the price by 1%, do all the customers go away? If you increase the price by 5%, 10%, what is the behavior likely to look at? Old example from Warren Buffett was Coca-Cola versus RC Cola, right? Discount cola prices went up 1%. Everybody switched to the next cheapest cola. But if Coca-Cola or Pepsi increased their price by 20%, most of the people still bought it, right? So there's other expression here is there's no value in being the second cheapest, but there's a lot of value in being the most expensive. Gets into other items, but the consideration is similar in that, is there pricing power? And if you need to pass through costs of, say, inflation, things of that nature, will that be tolerated or will that need to be incurred by the bottom line of the business? Lastly is pricing as a percentage of the ultimate customer's revenues. And so if you look at a business that sells a widget into fighter jets and that widget costs 1/1000th of the price of the total fighter jet, however, the criticality of it is incredibly important, then the durability of that customer is incredibly strong. Whereas if you are the single highest cost for a customer, your product, service, or offering is the most expensive thing they buy every year, then you rest assured that every time that they go over their budget, they're going to figure out how to lower that cost. Is there an alternative, etc. Right? And so if you look at a business and you look at their service or offering and you say, what portion of the overall spend pie of each of their clients does this represent? Sometimes the smaller is the better, right? And that, in conjunction with the other variables, is what makes for a very strong customer. And so to recap, 5 variables when a discussion ultimately moves towards looking at the clients of business. The customer concentration, the customer considerations of the mergers and acquisitions, or of a merger and acquisition, capital sourcing. Those are customer concentration, tenure, stickiness, switching cost, criticality, all kind of in the same consideration there. Pricing power, and lastly, the percentage of revenue of the ultimate client that this service offering or product represents. So that's a thought for today. In every M&A or capital process, there's going to be certain things that get dug into at different junctures, and one of the main things is going to be the customers, and these are 5, not all of them, but 5 of the primary considerations when the customer consideration discussion takes place. Hope the week's going well for everyone. Keep pushing forward. God bless. We'll see everyone next time.